Good afternoon, everybody. I'm Richard Green. I'm director of the USC Lusk Center for Real Estate, and it's my pleasure to welcome you to episode 65 of Lusk Perspectives. And we are thrilled to have with us today the chairman of the advisory board of the Lusk Center for Real Estate, Kev Zoryan, a longtime friend of mine, and a new founder of a new company called Arselle Investments. And I was going to tell you all about that, except I'm going to have Kev do that instead. So let's start. Again, I didn't introduce you very much because I want you to introduce yourself. Tell us about your professional journey to starting your own company within the last year or so.
Well, great to be here together with you, Richard, in the podcast series. It's very exciting to spend some time together talking about real estate and USC Lusk Center altogether. I originally actually went to the USC because of the entrepreneur program. And it was one of those programs that kind of caught my attention when I was in high school, mainly around the notion of being part of something that was experiential, hands-on, et cetera, and was very excited about that. Came to USC with that intention, and then very soon thereafter, that was the early 90s, I realized that there was a very significant a gap, if you will, in sort of interest in real estate, and of course, sort of having been a student, dug in a little bit and realized that USC had the early days of a great real estate program and some folks who had really been leading real estate in Southern California. More interestingly than that, of course, at the time was that I found that the 90s was going through a pretty difficult recessionary period for real estate, in particular in Southern California, and a lot of sort of changes in job patterns. And of course, the savings and loan crisis, the Resolution Trust Corp days. And so I started to get very interested in real estate in addition to the entrepreneur program, and ended up doing a dual major between the two within the business school, which I think was before it was called Marshall. But nevertheless, ended up doing real estate, finance, and consulting work in the beginning. And then, of course, the opportunity set became very much related to distress of what was coming out of those RTC type portfolios, and ended up working.
And Kev, excuse me, but for our audience, could you just say a little bit about what the RTC was?
Of course. So the Resolution Trust Corporation, which again, one of the founders and architects of the RTC was our very own Stan Ross, and something that obviously is very near and dear to an individual that was a big part of the arc of the Lusk Center and the real estate program at USC. The RTC was set up very simply to clear the loans that were created, in the period prior to that, that were non-performing or had issues. And so the opportunity thereafter was to invest in that. That's kind of what got a lot of Wall Street and private equity type investors interested in real estate and real estate investing. And so the early days of my career were around NPL, non-performing loan workouts related to a lot of the loans that were as part of that portfolio, or the assets that were coming out of that portfolio. Obviously, many of them were distressed. Many of them had complex issues that had to be restructured, redone. Obviously, properties, needed to be dealt with. And so the early days were really tied to that distress. Ultimately, the opportunity became much more of a traditional sort of private equity set. And of course, from there, having the formation of the closed-ended fund world, ended up working on that side of the business, and spent the next 25 years, perhaps unexpectedly, having sort of been originally interested in entrepreneurship, as I had sort of noted, ended up in a career for 25 years on a Wall Street sort of type trajectory for many years. The formation of Arselle, and sort of hit on that a little bit, and I'm sure a lot of this will be, part of the conversation that we have today, to me, was about a few things. One, as a result of the recession in the early 90s, felt really strongly that the number of individuals who are actually leading organizations today, we're facing significant tailwind, I'm sorry, significant headwinds as it related to their succession issues. And I think a lot of that was rooted in the fact that folks didn't go into the real estate business in the early 90s as a result of the S&L crisis and the RTC days. And so I think that opportunity set, sort of fast forward 30 years, really created a gap where you have great organizations, great principals and leaders of these organizations looking for an opportunity to really sort of preserve their legacy in their organizations. But because people weren't in the business for a very long period of time, there are gaps, that sort of that demographic professional gap, if you will, fast forward to today, is what's showing up in many of these organizations. So our idea really is to help, sort of, if you will, step into the role of that GP, help capitalize and recapitalize these organizations, providing the runway for the existing leadership to ultimately do whatever they want to do relative to their transition needs, and of course, sort of helping the next generation step up and become a leader of the organization. Of course, that requires capital, it requires strategy, and so our idea is to really find a spot in that general partner role in those types of organizations going forward. We are a real estate investor first and foremost, but of course our idea is that if we approach it from that perspective, we have access to differentiated flow, differentiated opportunities to invest in real estate through great organizations that, of course, are going through their various changes and needs. So that was the genesis for Arselle, and it's been a fun journey. We've been in business for about 3 months now.
So let me just come back to a few of the things you said. If you could expand on what you mean when you talk about GPs, because our audience, I'm hoping they're members of our audience who don't think about deal structure in real estate every day. So when you talk about taking on the GP role, tell our audience exactly what that means.
Of course. So I would say that in the industry today, the predominance of operating companies are smaller investor developers that basically are the ones that find the deals, that acquire the deals, and then asset manage and execute the deals. And that group of individuals serves the role of the GP of that deal. They serve the role of the team that executes the business plan. So in that way, ultimately, there are many different types of organizations in our industry. Of course, there are REITs that have their own capabilities, both capital and operating. But on the other side, there are these many great organizations that are specialty, sort of experts in different product types, different market types, et cetera, different types of investing in terms of risk. And we'll talk about that, I'm sure, in a little bit. But the general partner is the one that really takes the lead in executing those things. And the limited partner is the capital that comes in, which is the part of the business that I spent most of my career doing. So that's the sort of difference between the two at a very high level.
And since we're here in Los Angeles, I always think of the parallel between a GP in a real estate deal and a producer on a movie. It's basically the person who takes the idea and then tries to get it executed. So in the end, if you're a general partner, you wind up with a property that's finished. If you're a producer, you wind up with a movie that's finished.
Yep.
And I think
I also think of it as the conductor of an orchestra, because ultimately, in order for the music to be created, it requires all the different instruments to play together in different ways, and every instrument is a different expertise.
that's true. Although I think the general partner has a harder job because generally once you've assembled the orchestra, they're all there at the same time and you can get them to do what they do. And what the general partner has to do is choreograph a whole bunch of people to do different things at different times and get the sequencing right. And it's a skill that I don't know that many people understand or appreciate from the standpoint of getting a building up out of the ground and completed.
Yep. Look, it's a very important point and a very important question. Of course, having been on the capital side, of our business, having the right team in place is incredibly important. And the right team also, in addition to the general partner, requires all the different, parts of the real estate ecosystem to be a part of this team. Everything from the entitlement and permitting piece of it to the design and the structural, all the different components of what goes into, putting together a project, then executing it, the construction team, and then of course, once the building is built, there is leasing, and then eventually there is, the sale and the monetization, and of course, how you capitalize the deal along the way. I think, the ecosystem of real estate is very rich in terms of the various different ways that someone can participate with all the different types of disciplines, backgrounds, expertise, of course, working together, under and together alongside, that general partner.
So I'm going to step away for a little bit now from what you're up to with your business. We're going to return to it toward the end of the conversation. But I just want to now start talking more broadly about what's happening in real estate capital markets. And again, given that I'm hoping we have a more general audience here, could you just tell us a little bit, when you hear the phrase real estate capital markets, what do you think that means?
I think that real estate capital markets is ultimately the process of identifying and pricing the risk of a particular deal, and then finding the appropriate capital and funding to attach to it, right? At the end of the day, there is all kinds of different types of liquidity and illiquidity, of course, in real estate. And that capital is looking for different types of attachment points into real estate. And real estate sort of being part of the broader investment ecosystem. Of course, there's equities, and you can get to real estate through different types of real estate equities, REITs, et cetera. And then there's debt, of course, in the world of sort of bonds, et cetera. But in the world of real estate alternatives, the act of identifying a willing investor that has capital and a willing project that needs capital, to me, is the capital markets. And then the more complicated answer is that each of those different types of sources of capital will attach at different parts of the capital stack. It'll attach at different points of risk within a deal. Even the deal itself, has to be assessed. So I think our role as capital markets individuals in real estate is really to price risk and then to find the liquidity that's available that is interested in attaching to that risk. There are, of course, many, many different roles within that. There are intermediaries, there are lenders, there are equity providers, and consumers of all that capital, of course, in what that is. And that sort of total ecosystem of individuals, to me, is the sort of real estate capital markets. Again, very many different ways to slice it, but in particular, as it relates to how, we think about a real estate deal on the balance sheet, there is many, many different types of risks that are taken on any given deal, based on how the capital comes in, how it's structured, how long it stays in there, et cetera. So that to me is the function of the capital markets for real estate.
So this is going to prompt a question that I did not send to you in advance, but I'm thinking about, you can think about categories of providers of capital, right? You have insurance companies, you have pension funds, you have sovereign wealth funds, you have private equity, and there are others, but let's just talk about those four briefly. How do their motivations differ in terms of how they're thinking about placing capital? Or do they not? Or is it more that within each class you have different players with different motivations, but the classes themselves, if you look at them as a whole, are quite similar to one another?
They are very similar at a very big picture, but they're also very, very different, right? At the end of the day, each one, you have to understand the motivation of what they're trying to accomplish. You have to understand their own underlying investor motivation. You have to understand what those investors are seeking in terms of long-term returns. And then, of course, as you get the larger and larger in these organizations, there is a whole portfolio theory piece that goes into it. So if you sort of take equities big picture, you take fixed income instruments. Big picture, then you have the alts, and inside the alts, you have this world called real assets, and inside real assets is real estate. And so each of those different providers of capital have their own various strategies around how they want to put capital under real estate alternatives. And real estate alternatives could be everything from going into fixed income type instruments and debt instruments, or it could go into open-ended funds with evergreen capital, the ability to continue to sort of redeploy capital for a very simple description of what that is, or closed-ended capital, where the capital would go in with a specific intention, purpose, and timeline. It goes in and it comes out. And so I think as it relates to each of those different types of investors, the ultimate intentions and goals are tied to what they're trying to accomplish. If their basket of investments in the portfolio, require more risk, less risk, whatever it may be, you'll see different types of investors come to different deals. Some want to be in funds, some want to be in direct deals because they have some ability to sort of select product types. Some want to be in particular markets. Some want to be in global funds, in global investment situations where they're investing across a whole spectrum of different types of deals on a commingled basis. But ultimately, each one has their own strategies. I would say the thing that's probably most interesting is to really think about the investment duration of the source of funds of each, right? And so ultimately, life insurance companies are obviously, their predominant sort of focus and goal is to have a basket of investments that are there for their life insurance customers. Sovereign wealth funds obviously are, tied to whatever goals they have for their long-term investment needs. Private equity funds, to the extent that obviously, private equity funds are likely getting their capital from a life insurance company or a pension fund or a sovereign wealth fund, their intentions are really tied to the particular strategies that they're advocating, the particular strategies that they're sponsoring. And so from that perspective, they all may look very similar at a very big picture, but each one attaches a little bit differently based on the risk, the duration of their capital, and the strategies they have within their broader portfolio.
So that's going to prompt another question about duration. So real estate by its very nature as an asset has long duration, right? So you want to match it against long liabilities. So for a life insurance company, you have very long liabilities, right? Although I suppose as we as a society are getting older, the duration of those liabilities are getting shorter. Pension fund, similar sort of thing. Whereas private equity, if you have a closed-ended fund, you may be 5, 6, 7 years from the end of the fund. It's sort of like, banks shouldn't be taking on long-term assets because they have short-term liabilities. And one of the things that got Silicon Valley Bank in trouble and First Republic Bank in trouble was that mismatch. Do you see mismatch problems with closed-end private equity funds and real estate? And I'm not just talking about today under current circumstances, but just as a class, does that create a complication for closed-end funds that you don't have for these other vehicles?
Yeah, I would say that a couple things. One, you have the bigger picture, the availability of capital. Each of those different sources of capital have their own forecasts of what is going out and of course what's coming back. And so to the extent that you sign up for some type of a closed-ended structure that requires capital to be called over a period of time, you're obviously planning for that. And in a situation where, to your point, you have an illiquid asset like real estate, the duration needs of that could change based on different things that happen in the capital markets, illiquidity at a moment in time, availability of financing, et cetera. The other piece, of course, and I'm sure we'll talk about it in a little bit, is the need for financing and refinancing, right? Ultimately, those could be things that could have an impact on the big picture outcome. But I will say, I think the more important thing as it relates to these types of capital, these buckets of capital, is they're investing based on certain repatriation periods of their own time frames, et cetera, and the ability to continue to invest in real estate or other alternatives is obviously tied to the liquidity that's available for that strategy. And of course, as we're seeing now, for organizations like some endowments where there's questions around how taxes may work, et cetera, that need for liquidity and illiquid assets has created, a whole different market now. In fact, a whole different market that I don't have a lot of experience in, but around secondaries. And so ultimately, the ability and need to, provide the right matching of capital to strategy is obviously very important. It's a lesson we all learned in the great financial crisis. You match your, assets and liabilities in terms of duration, and you leave enough flexibility in there for some things to change, because invariably they will.
So let's now just go back to sort of a broad sweeping statements about the history of capital markets. What are the innovations that you've seen? And, innovation can be a good word and not so good a word. So like subprime mortgages were an innovation. I think it did not end very happily. But there are other innovations that, I'll give an example. Uh, treasury inflation protected security,
Tips.
Trips, right? Great innovation in financial market that allows people to hedge their inflation risk. Sort of within the world of real estate, what innovations have you seen since the early 1990s when you started working on this stuff, and which have worked and which haven't?
It's interesting. You outlined the different types of investors that have gone into this business over the years. I would say that historically, real estate, real estate private equity investors, if you go back far enough, were very long-term holders, right? They were very long-term holders. They owned land over a long period of time, generally self-financed or financed through some kind of, other sort of cash flows, et cetera. And for lack of a better way to describe it, those investors were highly multiple focused, right? They were focused on the multiple of returns of their investments, or in some cases, if you're a long-term holder of real estate or a long-term holder of land, you were obviously very much focused on the return of new capital being deployed into real estate. I think today, obviously, the industry's gone, to a very different place, right? There's a complete stratification of that risk, right? You can be a lender, you can be an equity owner, you can be an open-ended equity owner, you can be a closed-ended equity owner, you can be an owner of a development deal, you can be a cash flow. So I think at the end of the day, the what I think is probably the biggest innovation is the notion that obviously we've sliced up and stratified the risk in very, very significant ways over the year. And I think ultimately, that is, the innovation there is the sort of advancement of pricing risk. And then, of course, sort of taking the risk that you price and matching it with the liquidity and investors. And at the end of the day, what you're trying to do is get more bespoke products for the risk someone is willing to take, right? And so that probably is the greatest innovation. I will say that as it relates to closed-ended capital going into real estate, I think it's a very, very important part of our real estate capital ecosystem, and it will continue to be. I think the key considerations around is making sure that when you bring closed-ended capital, you have adequate amount of reserves and capacity flexibility to be able to flex up and down as it relates to the investments you hold, or the timing, because ultimately, some of these investments will take longer to go through a life cycle. It'll take longer to get through entitlements. Entitlements today are very complicated in many municipalities, and the
Kev,
duration on the front end.
just real quick, is that a uniquely California phenomenon, or is that pretty much everywhere?
Well, I would say it's not a uniquely California phenomenon, but I would say that most of most of the coastal markets where a lot of the institutional capital over the years has gravitated to, it has become much more complicated to get entitlements. It has become much more complicated to put projects, into production, into motion. That's not to say that it's easy other places, but there are some places where it's easier. And of course, at the other part of the way of sort of thinking about this is if you have a forecast, a pro forma for a deal that assumes the basic sort of certain timeline, anything that takes longer, especially where you have, and today, again, we talked about pricing risk and matching that return. The biggest difference today is that stratification of risk has led us to being focused on returns in terms of internal rates of return and those types of metrics for return as opposed to multiple. And of course, in a scenario where you have duration extension, et cetera, obviously there is a big impact to those returns over time. So if you don't get the timeline that you thought you were going to get, of course, that has a big impact on how the outcomes of your deals are. And that is, of course, sort of the way that the industry works today. And then, of course, now we also have larger, commingled structures that, of course, put those risks together, tries to blend out, if you will, smooth out those risks and ups and downs to, ultimately end up with a basket or a portfolio of real estate assets that, combine into a blended return.
Let me ask about, I'm going to ask another question that I didn't send you, but we're talking about return measures. I think it's worthwhile to spend a few minutes talking about IRR. Now, as I'm sure you know, finance professors hate IRR as a metric, and I think the principal reason is because it's so easy to manipulate. It is just depending on your timing of when you lay cash out versus you can make IRR look better than it actually turns out to be. So that's the first thing. The second thing, though, is I think about something that I heard Rick Caruso say once. And for those in the audience who don't know who Rick Caruso is, he is a well-known developer here in Southern California. He's the developer of the Grove and the Americana, two very well-known shopping centers, as well as others. And I remember him once saying he doesn't use IRR because to do IRR, you need to know what your exit is, and he never really knows what his exit is. And he's absolutely right. It's very sensitive to when you sell and what you sell for. So what is, not the market's view, but what's Kev Zoryan's view about the right way to think about return metrics when you are doing real estate investment?
It's a very good question, and of course, just like anything else in real estate or any type of investing, your willingness to put your liquidity into something is based on an expectation of what the returns are going to be. And certainly there is a way to do it based on multiples and those types of, or it could be based on a yield based on cash flow, right? The sort of net cash flow of a deal or the NOI of a deal over what your basis is. But at the end of the day, I think ultimately, because our industry is in all of portfolio investing ultimately ties to what are the annualized returns of an investment, irrespective. And of course, when we talk about that stratification of risk, right, you're talking about the different buckets of things that you can invest in. Ultimately, you need something to create that consistency and the normalcy across how you would calculate those returns. So in as much as IRRs at the end of the day can be, the forecast can be anything for a deal. Of course, you have to find, the right metrics of what something would lease for or sell for, what you think the ultimate exit would be in terms of yields. All those things are very, very important assumptions that go into it. At the end of the day, the IRR at the end of the deal, and that which compares it to every other alternative you have, is the way to measure the outcome of those deals. That's number one. Number two, it's how the entire ecosystem is set up in terms of how profits get split up between the various different investors and operators and so on and so forth. So ultimately, that is the more traditional sort of method of calculating returns and how it ultimately sort of ends up getting divvied up at the end when the transaction is held to success. Of course, again, there are other ways to do it, but that is the case. Of course, if you are a long-term holder and you're buying and building and holding great real estate, what matters is the return, the cash flow capabilities of that asset, the ability to lease that asset over the course of a long period of time. In the case of assets that require a lot of capital, of course, tenant improvements, et cetera, you have to put that in your calculation as well because your basis continues to change. And then ultimately, the goal is for, the value appreciation to carry. And that is important as well. But again, most of, the liquidity that ends up in real estate alternatives ends up in alternatives for a finite period of time for a finite particular purpose, and then is repatriated and redeployed.
So you're discussing splits makes me think about how GPs are compensated, and I think it would be great to have you talk a little bit about the evolution of that over time, because again, for those of the audience, GPs are generally compensated two ways. One is they receive fees for putting the development deal together, and the fees are some percentage of the amount of money outstanding to do that deal. And then they get a split on top of a preferred return to the limited partner. So you will set up a deal that says, limited partner, um, until you get all your money back plus, say, 10%, the GP gets nothing. But once you achieve that goal, the GP gets some split, 20/80, 30/70, above that 10% return to the limited partner. Have these compensation arrangements been changing over time, over the years that you have been doing this business?
I think the biggest change I think that happens in waterfall structures and carried interest structures, promote structures, really they're all kind of interchangeably used in terms of how they're defined. Ultimately, is the setting of the hurdles, right? Is sort of where do you set the first hurdle? What is the right preferred return relative to the risk you're taking? And some of that is a spread to what is less risky, right? What is the sort of the range of different types of risks that you could take, and then of course from there, the ultimate splits, would get likely based on the outcome of a transaction and how you sort of move from this step to this step to this step. You participate in better upside, and of course the intention of this is to create an incentive alignment so that a deal will be a great performer, and that as the deal is a great performer, the the folks that are executing it have the ability to participate in it. It's a structure that obviously is deployed in many types of other types of private equity structures, et cetera. The only other thing that has come into play over the years, and then mainly is because that we are now obviously in an environment where there's much more near-term volatility in investment hold periods. Lots of things happen in a shorter period of time versus sort of longer drawn-out cycles. Now you have interest rates will move fast, or there's something like COVID, which obviously none of us would have ever predicted. Ultimately, those kinds of impacts, and of course, the movement of interest rates and cap rates, will potentially motivate you to sell something or to make a change in your business plan based on whatever you're seeing in the environment. And in those instances, you might have situations where you have high IRRs. High IRRs ultimately move through the waterfall, and so of course you have situations such as minimum multiples and things like that that now are every now and then introduced in some of these waterfalls. It's not very common, but certainly something that we see. And then of course the other piece, and I think this is the nuance to every single deal, is depending on the risk that is embedded in a deal, and depending on the alignment, the actual skin in the game that the operator or the sponsor will put in the deal. Of course, there is subordination of certain types of economics, of course, as well. Whether that's fees or the things that you'll see in different types of structures. Not always the case, and obviously they become very complicated in terms of how they're structured. But those are the nuances and things that I think have changed over the years. Of course, the biggest change in the industry, and a lot of this came after the great financial crisis, was that the large funds, of course, ended up in for the most part, in situations where their returns were crossed against the entire outcome of the fund. So in as much as the operating partners were in deal by deal or smaller buckets of deals, mode, the bigger funds, obviously, as in that for those that have that, ended up, which is again a more of an industry standard today, are have those returns crossed against, all the outcomes within a portfolio of deals in a vintage.
Yeah, the other thing, and I don't want to get too much into the weeds on this, but I also understand catch-up rules have changed, and limited partners are not interested in allowing for catch-up, which was a method that general partners could use to recover some of their money more quickly. Is that true?
It depends. I mean, I think everyone's a little bit different. I think catch up, still does exist, but there's definitely nuances to how that would work ultimately, and when you get, you're again, if you're crossing the whole portfolio to get to a catch up, you're already have returned all capital. You've already returned to pref, so now you're participating in some type of an acceleration of economics after a lot of things have happened in those instances. So it's there are a lot of different toggles.
So, well, so let's now talk about, more generally, how do you see the capital market environment right now?
I think that there definitely is a pretty significant um,
Oh, and by the
trade-off.
way, excuse me, now is June 19th, 2025, if somebody is watching this in 30 years. So, Kev, go ahead.
I think there is a pretty significant trade-off in sort of the marginal availability of capital and risk. And what I mean by that is you hear a lot of, why would I take that risk if I can get a credit product that gives me X returns, right? If I can do a preferred return, if I can do some type of a bridge financing or whatever it may be and get a higher, private credit type return. And so I think what's really, really important is, those types of situations where, you have quote unquote lower risk to get more relative returns that are attractive could be interesting. However, I think it's really, really important to make sure you actually underwrite in those instances the incremental risk that you're taking as it relates to that type of private credit construct. So, are you getting an X% return, and for 200 or 300 more basis points, getting this? I think so. There's a lot of trade-offs. I think that's sort of the trade-off in understanding the marginal return and marginal risk of equity or debt, but debt could also be, kind of equity-like, if you will, in some of these constructs. You need to really be careful and understand sort of how those incremental risks and those returns relate to each other. I do think that there is a fair amount of capital. We hear about, the formation of a lot of private credit funds of different
Mhm.
types. There's obviously the availability of pretty significant opportunistic and value add type capital that has been uncalled. There's probably less availability of capital in some of the more sort of lower risk open-ended structures because in those instances, obviously, there are redemption issues that many are working through. Though I would say that I think a lot of those redemption issues are starting to find their way. I think the thing
So,
that's probably the most
again, Kev,
interesting.
tell the audience when you talk about redemption issues, tell the audience a little bit about what exactly you mean by that.
Sure. So in a closed-ended fund, you put the capital in, it's called over a certain period of time. That money goes in as it's called into specific situations up until the cap amount, et cetera, of the fund, and then it's repatriated back to the investors. And then the investor decides how they want to redeploy the funds back into whatever strategy, real estate, et cetera. In the construct of open-ended vehicles, you put the money in, it goes in some periodic period of time, quarterly, over some period of time, number of quarters, et cetera. And then if you want your capital back in those instances, you have to go into what's a queue, and then the queue over time releases the capital to you as funds become available in those different various buckets. And there's obviously different examples of that type of thing that's happening today. When the redemption queues are increasing, in other words, sort of the inability of the underlying fund to pay out someone immediately based on their demands, that obviously stacks up and it takes time to get out. And so in those instances, again, real estate isn't a liquid asset class. And those structures, that's it's more liquid than a closed-ended structure where you're in and out over the period of time you're in. It's obviously less liquid than just buying, a public security where you can get in and out on a moment. So it's sort of the in between, if you will. And in those situations where there are open-ended structures, the happening of redemption queues obviously will limit those buyers' ability to make acquisitions because the liquidity they have is being utilized towards ultimately reducing those queues. And so those buyers end up on the sidelines. They're not as active unless they have particular other abilities to spend money, or obviously their investors are generally patient. And I think in most instances, investors generally are patient and they're trying to sort of understand in those constructs that they're gonna it's an orderly way in, it's an orderly way out. And so they're waiting for their turn. And some of it also has to do nothing with real estate. It could ultimately be just purely rebalancing their own portfolio because stocks went up and they need less of this or more of that or whatever it may be. I think that ultimately has an impact as well. So as we get into these bigger structures, of course, the outcome of how capital flows is very much tied to other things that are going on in these portfolios.
So just by the way, briefly for the audience, is there's this phrase for large portfolios called the denominator effect. So you'll have a target allocation to different kinds of assets, stocks, bonds, real estate, etc. If the value of one of those assets goes up a lot, like if the stock market goes up, that means automatically you have too much money given your allocation targets in the stock market. And so what you're going to want to do is sell that money in the stock market, put it somewhere else to return to your previous allocation targets. And that is something that moves money around in many of these funds.
Yeah,
Um,
and what's interesting
yeah.
actually to that point is as the stock markets have appreciated the last several years, the notion of sort of what that has done to the denominator, obviously real estate in particular, if you haven't added to your real estate portfolio, again, everybody has their own strategies, real estate would become a smaller piece of the total puzzle. And in instances where you see people are increasing their allocation to real estate, one is, is it catching up to that denominator? Two, are they over allocating relative to the past for various different reasons? Of course, in the last several years, inflation has been a real factor, and real estate, clearly has benefits as it relates to inflation to some degree in the total portfolio. So ultimately, there are lots of different reasons why the denominator will have an impact, and it's important because ultimately that should for the most part be a good sort of guiding light to how capital will ultimately find its way into alternatives and real assets, et cetera.
So there still are not a lot of transactions going on in the commercial real estate market. And so this is the classic problem of a bid-ask spread is we don't have price discovery. Yeah, let me put you on the spot and ask you, when do you think price discovery is coming? And it's going to come in the next 6 months. It's going to be a year. It's going to be 5 years. How long are we going to be in this sort of limbo, which we seem to be right now in the real estate market?
I would say in general, markets have been relatively optimistic. Of course, it is really tied to the haves and the have-nots around product types or balance sheets or whatever it is. So there's a pretty significant bifurcation. I think the bigger, more important thing, which doesn't have an answer, of course, is uncertainty and stability, the perceptions of what that means, and ultimately, it's the three T's: it's tariffs, it's taxes, it's trepidation, and ultimately, someone's willingness to take a step in something is tied to their willingness to feel confident that they're making the right decision for the environment. And so new capital, if you're worried about sentiment and you're worried about the complexity of what's going on, you're going to be less likely to be willing to part with your liquidity and dry powder. And so I think that's certainly a factor. The other part of it is you need to have willing buyers and sellers. And I think in a lot of instances, you have scenarios whereby the capital availability in situations has met the needs of the need for the exit on the other side, and there you end up with a willing buyer and seller, but they're fewer and further between, because ultimately someone doesn't have the pressure to sell, the need to sell. This, of course, this expectation that interest rates are going to go down has been something that has been driving a lot of that confidence in sort of not moving. Of course, what ultimately happens with lenders, and this notion of sort of the extending the pending maturity. I'm sure we'll spend more time talking about that, but those are all things that have to happen. So I do think that overall, the most important thing that can happen is more certainty. Those types of things obviously will continue to always be the case, but they all go on that calculation we do where we price risk, right?
So did you just coin the three T's? Is that yours, or did somebody else come up with
No,
that?
I just wrote it down earlier. I'm like, I
That's
got to
really
come up
good.
with
Tax and
something
tariffs and
interesting.
trepidation. I like that. I'm
I,
going to
well,
use it.
I came up with it, but if someone else has done it before, then I give them
No,
full
no, no. I
credit.
haven't heard it. So Kev, I
But
think you need to copyright it right away so that nobody else can take it from you. Um, so, I mean, tariffs are going to be the next thing I talk about because, one of the things that is the mirror image of goods markets and trade or capital markets. So the way the last, I don't know, several decades have worked in the United States is because we don't save a lot of money and because we run federal government budget deficits, um, we've needed foreign capital to finance our investments, and both in terms of our government investments and in terms of private investment. And the way it works is you could say they give us goods in exchange for us giving them assets, or we give them assets in exchange for thus giving them, I don't know which drives which. It's actually kind of an interesting question. But with the current administration's seeming determination to basically kill trade, if you kill it on maybe I'm wrong about that. I mean, of course, tariff policy changes by the hour. But if that were to happen, it would surely have an influence on the capital flow side of the market as well as the good flow side of the market. Do you see foreign investors talking about this? Do you see foreign investors looking anywhere else? Or is the United States still, because it's so large and its demographics are not great, but not as awful as a lot of other people in the world, still the place that people are going to want to look at when they're investing?
it's a very hard question, and I'm absolutely not qualified to answer all the next order effects. I will say that ultimately, if the intention is to, bring some of that balance back here, that means you have to actually do different things here, right? Different things with your capacity, your production, your whatever. And so there's obviously impacts to that. And of course, there are returns on that ultimately as well. And perhaps I think the sort of, the trepidation point, if you will, is that sort of interim step of how we sort of get from here to there. We can't, I don't think we can grow bananas in the United States, right? So how do you sort
No,
of,
that's not happening. Well, maybe in
yeah.
Hawaii, but yeah.
So there's a how you're replacing those things obviously are important. The thing I think is interesting, and we have had a number of different discussions with international investors in the last few weeks, and just our relationships over the years. And I think a lot of folks have sort of come to we can underwrite tariffs, we can understand sort of the impacts of that. There's dollars and there's friction costs and how that gets shared could be something that you can sort of get analyzed. I think the thing that I hear more from folks out outside the U.S. is I need to understand the tax policy and how is that going to change. I need to understand, the sort of interrelationships between sort of various governments and treaties and things of that nature, whatever it may be. It's a lot of that uncertainty, and so I think the feedback that I seem to be hearing is we don't like sort of some of the noise, right? And so as a result, we're just going to wait till we see where the dust settles. And and I think to some degree that really is the more complicated side of the equation because it's kind of hard to make those assessments. The other part of it, of course, is also, it's most of the decision makers in many of these organizations around the world, have very personal relationships with the United States, whether that's the educational system. Obviously, I don't know, very significant 25% of USC students are international students, and so on. And I think ultimately those kinds of, and maybe my math is wrong on that, but it's a significant
Oh,
number. And
that's about right. Yeah.
ultimately, those interpersonal, personal relationships also have a factor. So ultimately, their decision point is going to be, well, we're going to wait until we find out what's going to happen. And so I think that waiting in, combined with the lack of transaction activity, the very selectiveness of capital, probably actually creates more distress in balance sheets in the system than helps. And I think from that perspective, the other side of the coin is as capital pulls back, that probably creates, more uncertainty and more economic uncertainty, and ultimately, more situations where, things, may unlock, but they're going to unlock because that sort of marginal availability of capital that will take, that incremental risk or just even liquidity in the system, will not be the same, and so ultimately pulls back and creates, more stress on balance sheets overall. So I think that's a factor. I'll talk about it a little differently too. Just in Southern California, obviously, very significant trade, port,
Hmm.
and warehouse distribution market, and I think that's really really important because we have the base of the billion plus of industrial real estate here obviously is heavily impacted when you see port activity fall as much as you have, even in sort of short spurts or whatever it may be. Ultimately, that over the course of time is important for that. But the other side of it, of course, is this notion that advanced manufacturing and access to skilled labor and all those kinds of things, probably are more important today, right? And so there is a trade-off between, the more sort of traditional warehouse distribution and, what may be, infill, well-located industrial. And so, it's hard to sort of paint brushes that are very broad because I think the impacts, even within the real estate ecosystem and within product types, are going to have different impacts and different outcomes.
So I want to ask one more question, sort of about capital flows, and it involves the banking side as well as the broader capital markets. And then I just want to, we'll finish by talking about some of the other projects that you're involved with. But there's this constant worry about maturity cliffs. So again, for the folks at home who haven't done a commercial loan, the way commercial lending works is different from home lending. And when you borrow to buy a house, you get a 30-year loan, it self-amortizes, you pay it until it's zero and you're done. In commercial lending, you amortize over a long period of time, but you usually have to repay the loan in full in somewhere between 5 and 10 years. And that's what's being referred to as the maturity cliff. And people often got loans. Think about if they got a loan 5 years ago, it had an interest rate of 2.5%. And now they need to refinance that loan at 6, 7, 8%. So even if their building is fine, the ability to service that loan is much more challenging than the old loan. So, Kev, how much of this is a problem, and are we going to start seeing waves of default because of the inability of people to refinance their commercial loans?
I think it's a very important question, and let's step back because you hit on a couple of really important points around the backdrop. One, in the great financial crisis, we through that we changed, lending policies generally, big picture, and we didn't coming into this cycle, we didn't necessarily have higher leverage, highly levered balance sheets like we had in 2007-8. So that's sort of backdrop number one. So in that construct, we didn't over lever like we had in a previous cycle, which I think is important from a fact backdrop. Number one. Two, if you bought an asset with the intention of, taking, your cap rate up 200 basis points through rent appreciation or, CapEx you're spending, a few things happen. One, the cost of that CapEx went up because, inflationary pressures on the underlying business plans probably had an impact, number one. Number two, your expenses probably went up faster than you forecast. And three, your revenues probably went up, but didn't go up as much as you probably expected. On a net basis, your margin actually shrunk. And so overall, you're talking about a business plan that you thought you were going to get a 200 basis point increase with your strategy. Maybe you got a 100 basis point increase, or whatever it may be. You borrowed floating rate at SOFR 300. SOFR was zero for a long time. And that cost of financing, you had an interest rate cap in place that allowed you to basically preserve that low interest rate for some period of time. Unlikely that it was for the entire period of the hold, and so ultimately the cap rolled off. You didn't achieve exactly how much you did in terms of the appreciation of your business plan, and your cost of financing went up by 300, 400, 500 basis points as your caps burned off. And so on the margin, you're borrowing now negative leverage. And again, I think the math on a lot of that, just sort of taking big broad brush numbers, is somewhere between 10 and 15% of your loan balance. And so if you levered it, say 65%, and you've lost 10 to 50, and you've lost 10 to 20% of the value of the real estate, and let's just put aside, the binary situations of office or other things aside for a second, the math that you need to sort of cash in is 10 to 25% of your loan balance. So you're basically calling, effectively 50% or more of the equity you called in the beginning to actually remargin and refinance that loan. And I think that's the decision a lot of people are facing. So you have equity to protect. It's not necessarily.
That makes this very different from 2009.
Very different, where it was just not worth the debt. Now you have equity to protect, but it's significantly less. And then you have the issue of maturity, which again, we can talk about how banks ultimately, I think we're seeing more and more banks that are, starting to deal with those issues over time. But ultimately, if you have equity investors or it's your own, you're going to have to come up with, some meaningful number relative to your original equity investment to protect that investment and to delever the loan. And so that's the backdrop that's really, really important. And that's actually a lot of sort of the things that are going on within many organizations today is where do you sort of put that good dollar to protect an asset? So really, really important. I do think that we're hearing more and more that banks are seeing pay downs. There is availability of liquidity again. There's different types of structured financing. And if you ultimately believe that interest rates are going to go down, you would take on some more, complexity to your balance sheet with the hope that ultimately as rates go down, you have the ability to do something, or, as fundamentals recover, you have the ability to refi, et cetera.
And Kev, is that more mezzanine lending or is it more raising more equity?
I think it's both. I think, to the extent that many people, don't want to call equity, don't have the desire to sort of put in, the significant amount of equity that is needed for these, because again, it's just the math is pretty meaningful relative to your original capital call. Ultimately, it is mezzanine or preferred, and then of course the question becomes how do those get sort of resolved at the end, and so that's a big question. That's the moment we're in. I think that the opportunity, if you will, sort of the word that I use is this funding gap, right? The sort of that 10 to 25% required to cash in refinance is if it's $1 trillion plus of existing loans that need to be figured out, there's, a couple $100 billion of funding gap that needs to be figured out. And that's going to be figured out through these credit structures, can be figured out through new equity, or ultimately the repatriation of that asset. And so, certainly we're hearing, little by little, news that, there is more activity among lenders. As they get more payoffs, they have the ability to absorb more of the sort of impacts on the balance sheet, so they can actually get product through and move, so they can actually start redeploying capital, into other things. And so I do think that's starting to happen, but a lot of it is still being held at bay because the expectation that interest rates, would roll down. And obviously that has not been the case, throughout this year.
So let's finish by talking a little bit about the other stuff you do besides your day job. And in particular, you've been very active with us at USC throughout the university, and we're very grateful for that. But also, you were chair of the Los Angeles District Council for the Urban Land Institute, and you were instrumental, along with others, on putting together a report on how to recover from the fires that happened in Eaton Canyon and in the Palisades here in Los Angeles. And if you Google ULI, USC Lusk, UCLA Ziman, I'm pretty sure it's the only response you'll get if you have all of those three things in quotes in a Google search. You will find a copy of this report that we put together and that Kev contributed a lot to, including leadership. What is it that motivates you to do these sorts of things? And what would you recommend how other people pursue these sorts of things?
Thank you for asking that question. And by the way, you were equally instrumental in that process for the wildfire report, which obviously, is an incredibly difficult and tragic situation, and many of our members and colleagues and friends were impacted. I think the number one thing for me is I feel very fortunate. I feel fortunate that I had the opportunity to go to USC. I feel very fortunate that I had the ability to learn from the folks that I did at USC in the early part of my career. And so for me, what's really important is, that give back. It's really important to, find, the types of things that, I can give back to as a result of what, was afforded to me, many, many years ago. And I think that's part one. So I think education in particular is very, very important, and giving back to education to me is very important. And I will say, and we can talk specifically about the wildfires, that conversation is also very important as it relates to sort of the mission of USC, the mission of the Urban Land Institute, the mission of UCLA. At the end of the day, the conversation that you and I had, and the conversation that Claire and Lou and I had in those early days, was we have a situation where the mission of our organization is to educate, is to teach, is to sort of expand people's horizons around information and what's available, et cetera. And ultimately, the only way we're going to solve that issue is by expanding capacity. We're going to expand capacity in permitting, and expanding capacity in the actual construction, and the capacity of financing, and so on and so forth. And so when you talk about organizations like the three, the most important thing to me is, you have organizations where, the mission is education and helping others learn. And so ultimately that, to me, is what's really important, that educational piece. Two, look, I think that everybody has something that is a specialty, an area of focus, a thing, being able to sort of share the journey, and help others is really important, because I do think that, our learning has become very sound bites, right? And I think ultimately the complexity of the things we're dealing with today are far deeper than sound bites. And so ultimately, you can understand an issue at a soundbite, but then you have to actually, have the mentorship and the training to really actually understand the problems. And then, of course, from that comes the solutions and things that will help us innovate in the future. You asked about financial innovation. I can't wait to see where this industry goes around, how, we innovate as an industry. And I do think some of the things that are going to get deployed, specifically around the wildfire report will be innovations that ultimately help us with city planning and permitting and building in the days ahead. So, those are all things that are, in my mind, intertwined together, and very important.
So, Kev Zoryan, thank you very much for spending some of your time with us this afternoon. We really appreciate it. Very enlightening conversation, and will give our audience a lot to think about.
Thank you, Richard. Great to be on.